Welcome back to the deep dive.
Oh, okay.
Let's unpack this. Today we're plunging into a corner of finance that, well, often sounds intimidating, maybe a bit dry,
hmm
but trust me, it holds the keys to truly understanding a company's financial story. The secret language of modified opinions in auditor reports.
That's right.
Get ready because by the end of this deep dive, you're going to have your financial detective skills seriously leveled up.
That's exactly it. Imagine an auditor's report not just as like a company's financial report card, but as a critical assessment from an independent third party.
Okay.
While every company and, every investor hopes for that pristine, unmodified opinion, sometimes the auditor simply must issue what we call a modified opinion.
Right.
And these aren't just minor footnotes or technicalities. They are crucial, sometimes really screaming signals indicating significant issues with a company's financial statement.
Hmm.
And understanding them is, well, it's an absolute shortcut to being truly well-informed, allowing you, the listener, to see beyond just the surface numbers.
So our mission today is clear then. We're here to give you a straightforward, easy-to-understand breakdown of what these complex-sounding phrases like qualified opinion, adverse opinion, and maybe even disclaimer of opinion actually mean for a company. We'll strip away all the jargon, explain the why behind these modifications, and show you precisely what to look for. We want to transform you into a much savvier reader of financial statements.
Yeah.
It's really about empowering you to spot those hidden clues that others might just glance over.
Okay, so before we really dig into the nuances of those modifications, let's establish our baseline. The gold standard, the unmodified, or as some sources call it, the unqualified opinion. What does this actually mean, and why is it what every single company strives for? That ultimate financial thumbs up.
Well, the unmodified opinion truly is the gold standard. It's the coveted seal of approval in financial reporting.
Right.
It tells you, the reader, that the auditor has done their homework thoroughly. They've gathered what we call sufficient and appropriate audit evidence.
And this evidence allows them, with a high degree of confidence, to conclude that the company's financial statements, so its financial position, its results of operations, and its cash flows are presented fairly.
Fairly.
Yes, fairly in all material respects, and that they adhere to the applicable financial reporting framework like GAAP, generally accepted accounting principles here in the U.S.
Got it.
It's essentially the auditor saying, look, we've checked, double-checked, maybe even triple-checked, and these statements, they're reliable, trustworthy, and they paint a true, unbiased picture of the company's financial standing. It's precisely what you want to see if you're looking to invest or maybe lend money to them.
So it's like getting a perfect score on a really rigorous exam. Everything checks out, no questions asked, no red flags anywhere. That brings a huge level of comfort to anyone relying on those numbers, doesn't it?
Exactly. It's the equivalent of receiving a completely clean bill of health after a very thorough medical examination. You can move forward with confidence.
And there's almost always a but in finance, right?
Right. Yeah, usually.
What happens when that financial picture isn't quite so perfect? That's when we leave that realm of the clean bill of health and enter the much more intriguing and sometimes concerning territory of modified opinions.
Yeah.
This is where the story gets a lot more complex and, honestly, often a lot more interesting for the financial detective in all of us.
You're absolutely right. A modified opinion is essentially the auditor's way of saying, okay, hold on. We cannot issue that pristine, unmodified opinion because something here isn't quite right, and we really need to draw your attention to it.
Okay.
Now, these modifications typically arise from two broad, sort of distinct scenarios. The first scenario, and this is our main focus for this deep dive today, is when there are material misstatements within the financial statements themselves.
Material misstatements.
Yeah.
Yeah.
This means the numbers or the classifications or maybe the disclosures within the company's reports are fundamentally wrong or misleading in a significant way. Like, for example, a company might have miscalculated its revenue significantly or maybe failed to disclose a major liability that's looming.
Gotcha. That sounds serious.
It is. Now, the second scenario, which is equally serious but stems from a different root cause, is when the auditor is unable to obtain sufficient appropriate audit evidence.
So they couldn't get the info they needed.
Exactly. This isn't about the company's financials necessarily being wrong, but about the auditor not being able to gather enough reliable information to actually form an opinion in the first place.
Okay.
Imagine trying to verify a company's inventory, right? But management restricts access to their warehouses. Or what if crucial financial records were, I don't know, inexplicably lost in a fire or a major system crash?
Right, something prevents the audit itself.
Precisely. In such extreme cases where the auditor simply cannot do their job effectively because they lack the evidence, they issue what's called a disclaimer of opinion.
A disclaimer. Okay.
Yeah, it's their way of basically saying, look, we literally couldn't do our job because we weren't given the tools or the access needed to form a judgment.
Wow.
While it's maybe less common than issues stemming from misstatements, a disclaimer is an equally serious red flag. It signals a complete lack of transparency or maybe control. And for you, the user of those financial statements, it means the auditor is explicitly telling you they cannot vouch for the reliability of any of the numbers.
So, okay, on one hand, you've got misstatements where the financials are actively wrong.
Mm-hmm.
On the other hand, you have a disclaimer where the auditor can't even tell you if they're right or wrong because they couldn't get the information. Both are huge alarms, just signaling different kinds of underlying problems.
Exactly. Different problems, equally concerning outcomes for anyone relying on those statements. And understanding why an opinion is modified is absolutely crucial because each type tells a very specific and different story about a company's financial reporting health, its management, perhaps its internal controls.
Okay, here's where the detective work really starts to pay off, I think. How does an auditor dealing with all this complexity actually decide when to raise, say, a qualified flag versus a full-blown adverse alarm?
Yeah.
What's the secret sauce behind that decision?
Right.
It really boils down to two key terms that auditors live by. You hear them all the time. Materiality and pervasiveness. They might sound like dense jargon at first.
They do sound a bit academic.
Yeah, but they become incredibly intuitive once you unpack them.
They really do. Let's start with materiality. Think of materiality as the significance of an omission or a misstatement.
Significance. Okay.
Yeah. An item is considered material if its absence or its misstatement, whether on its own or added up with others, could reasonably influence the economic decisions of someone who is relying on those financial statements.
So, like, would it change my mind about investing?
Precisely. So if a company makes a tiny arithmetic error of, say, a few $100s, that's almost certainly not material. It wouldn't change your decision.
Right.
But if they misstate their revenue by millions of dollars, or if a significant expense is incorrectly classified in a way that dramatically impacts the reported profit, that absolutely is material. It's all about whether the error or omission truly matters to someone trying to understand the company's real performance and financial position.
Okay.
Now, materiality is fundamentally a judgment call by the auditor, but it's always about the potential impact on the user on you. Now, pervasiveness takes materiality a crucial step further.
Okay.
While materiality is about the size or the nature of a misstatement, pervasiveness is about its widespread impact across the financial statement.
Widespread impact.
Yeah. Is the issue isolated? Is it just in one account or one transaction, like maybe a single inventory miscalculation? Or does it ripple through and affect many different elements of the financial statements?
Ah, I see.
Does it fundamentally alter your understanding of the financial statements as a whole? If an issue is pervasive, it means its tentacles, so to speak, reach across the entire financial picture. It makes the entire set of statements potentially unreliable at their core. It's not just that a specific line item is off, it's that the entire narrative the financial statements are trying to tell becomes fundamentally misleading. It casts doubt on everything else.
So it's not just about what the problem is, but how big a problem it is that's materiality, and then how widespread its tentacles reach across the financial statements. That's pervasiveness.
You got it.
That truly determines the severity of the auditor's judgment.
Yeah.
And the real insight here seems to be that even a seemingly minor accounting tweak, if it's pervasive enough, can completely unravel the trust in a company's entire financial narrative, which for you, the investor, is a fundamental red flag signaling some deep issues.
Exactly. And our sources lay out a very clear matrix, actually, for how this interplay between materiality and pervasiveness determines the type of opinion the auditor issues. So first, if an issue is none, or immaterial, meaning it's insignificant, wouldn't influence decisions, the result is an unmodified opinion.
The clean bill.
Right. That applies whether it's a potential financial statement issue or an audit scope issue. That's our clean bill of health. But if the issue is material but not pervasive.
Okay, so it matters, but it's contained.
Exactly. It's significant enough to matter to a user, but it's contained to a specific area and doesn't fundamentally break the entire financial picture.
Yeah.
Then the auditor issues a qualified opinion.
Qualified?
Yeah. Think of it as a clear warning sign about a specific area, like watch out for this particular account or pay attention to this specific disclosure. The rest of the financial statements can generally still be relied upon, but with that specific carve-out.
So for me as a reader,
For you, it means you can probably still use the financials, but you need to pay very close attention to the specific issue the auditor flagged and maybe adjust your analysis accordingly. However, if the issue is material A&D pervasive,
both.
both.
Mm.
Significant and widespread impact. This signals a much more severe problem. Now, if it's a financial statement issue, meaning the numbers or disclosures themselves are fundamentally wrong and misleading across the board, the auditor issues an adverse opinion.
Adverse. That sounds bad.
It is. It's the strongest condemnation an auditor can make regarding the statements themselves. It's essentially saying these financial statements as a whole cannot be relied upon because they do not present a fair picture. It's like a total system failure in reporting. And just to complete the matrix, if the issue is material and pervasive, but it's an audit issue, meaning the auditor couldn't get enough evidence to form an opinion on the statements as a whole, then they would issue that disclaimer of opinion we talked about earlier.
Right, but couldn't do our job one.
Exactly.
Okay.
They're disclaiming responsibility because they couldn't perform their audit due to a pervasive limitation on their scope or lack of necessary information. Both an adverse opinion and a disclaimer of opinion represent, frankly, catastrophic failures in financial reporting or the audit scope.
Mm-hmm.
And for any external party, they immediately raise profound questions about the company's viability, its trustworthiness, and its future.
Okay, so we've got our map of auditor opinions now, and we understand the severity scale. Now let's put on our detective hats again and shine a light on what kinds of clues, what specific financial missteps actually trigger these modified opinions based on material misstatements in the financials themselves. Our sources lay out three crucial categories, right? Each pointing to a different type of underlying problem.
Indeed. The first area where material misstatements can pop up is in the appropriateness of accounting policies.
Appropriateness of the policies themselves.
Okay. Yeah. This category deals with whether a company has chosen and applied the right set of rules for its accounting in the first place. Think of accounting policies as the fundamental principles, the conventions, the methods a company uses to prepare its financial statements, like how it recognizes revenue, how it values inventory, or how it accounts for long-term assets.
Got it.
Misstatements in this area happen when, well, a few things. First, the accounting policies chosen are not in accordance with the applicable financial reporting framework.
So they just picked the wrong rule.
Essentially, yes.
Ugh.
For example, a company might choose an accounting method that simply isn't allowed under GAAP for a particular type of transaction. It's like trying to play basketball, but instead of dribbling, you decide to pick up the ball and run with it, claiming soccer rules apply.
Right.
The entire game is fundamentally misplayed from the outset because the foundational rules being followed are just plain wrong. This isn't a small mistake, it's a fundamental misunderstanding or maybe even an intentional deviation from the accepted playbook. Second, and this one's a bit more nuanced, even if the chosen policies are generally acceptable under GAAP, the financial statements do not represent the underlying transactions and events in a manner that achieves fair presentation.
So following the letter but not the spirit.
Exactly, that's a great way to put it. You might be technically following a rule, but if the overall picture it creates is misleading because of how that rule is applied in a specific context or industry, it's still a problem. It's about whether the financials are painting a true, unbiased picture that genuinely reflects what's happening, or are they subtly misleading you, even while, ticking some technical boxes. And third, under this category, the entity has not complied with financial reporting framework requirements for accounting for and disclosing changes in accounting policies.
Changing the rules mid-game.
Kind of. Companies sometimes legitimately need to change their accounting policies. Maybe there are new regulations, a big shift in their business, or a new accounting standard comes out.
Okay.
But these changes need to be disclosed properly. You need clear explanations of why the change was made, and often you need to restate prior periods to make sure things are still comparable.
Right, so you can compare apples to apples.
Precisely. If a company just suddenly changes how it reports something, without proper notification, justification, or a clear explanation of its impact, it dramatically obscures your ability as a user to compare performance from one period to the next. It makes trend analysis almost impossible.
So whether it's using the wrong instruction manual entirely for some highly complex machine or changing the manual mid-build without telling anyone, it makes it incredibly difficult, maybe impossible, to understand what's actually going on inside the company. And that lack of comparability is just a killer for anyone trying to analyze trends or make informed decisions.
It absolutely is. It undermines the very foundation of reliable financial reporting. It can render historical performance analysis totally meaningless. Okay, moving on to the second area, we have misstatements related to the application of accounting policies.
Application. So this is different from choosing the policy.
Yes, exactly. Here, the policies themselves might be totally appropriate, totally fine under GAAP, but management is simply not applying them correctly in practice.
Ah, okay. Execution error.
Precisely. It's like having the right recipe, but then using the wrong measurements, or mixing the ingredients incorrectly, or maybe following the steps out of order when you bake. The recipe's fine, the execution is flawed. This can happen when, for instance, management has not applied accounting policies in accordance with the applicable financial reporting framework. A classic and really impactful example from our source is expensing rather than capitalizing an asset.
Okay. Break that one down. That sounds important.
It really is, because it's a perfect real-world illustration of how a seemingly simple application error can ripple right through the financials. So when a company buys a significant long-lived asset, think like a big new piece of machinery or maybe a building gap, generally requires them to capitalize it.
Capitalize.
Meaning they record it as an asset on the balance sheet. Then they gradually expense its cost over its useful life through a process called depreciation. This approach matches the cost of the asset with the revenue it helps generate over time. It gives a clearer picture of its long-term contribution. However, if a company incorrectly expenses that asset immediately,
Just writes it off right away.
exactly, it goes straight to the income statement as a cost in the current period. What's the immediate impact? Well, higher expenses, which means lower reported net income and also lower assets on the balance sheet, at least in the short term.
Okay.
But the long-term distortion is often worse. Future periods won't show the depreciation expense that should be there, making future profits look artificially higher, and the balance sheet will permanently understate the company's true asset base.
Wow. So it messes up both the short-term and the long-term picture.
Completely. For you, the investor, this means the company might look less profitable right now than it truly is, but then maybe more profitable later on, and its asset base will be understated. This one simple application error can completely distort profitability, asset valuation, and the perception of overall financial health.
And why would a company do that? Error or
It could be an error, absolutely. Or sometimes companies might do this intentionally, perhaps to manipulate short-term earnings, or maybe to avoid showing a larger asset base that could trigger certain financial covenants or tax implications.
Right, that's where the rubber really meets the road then. You might have the right recipe, the right policy, but if you're mixing the ingredients incorrectly, or maybe not in the right order, the end product is still flawed.
Perfectly put.
That expensing versus capitalizing example is a fantastic illustration of how these seemingly small accounting application decisions can have massive distorting impacts on the reported numbers people rely on.
They absolutely can. Another common issue in this category is when management has not applied accounting policies consistently between periods or to similar transactions and events.
Consistency again.
Yes, consistency is paramount. Financial statement users need to be able to make meaningful comparisons over time. If a company uses one method for valuing inventory one year, say FIFO, and then switches to a different method the next, like weighted average cost.
Without a good reason or disclosure.
Exactly. Or if they treat similar sales contracts differently from one customer to another, it just makes meaningful trend analysis impossible. It's like changing how you measure your ingredients every single time you bake. The results become unpredictable, unreliable. You can't tell if the company's performance is genuinely improving or just changing because they tweaked an accounting method.
Right.
And finally, under application, it could simply be a straightforward error in the application of an accounting policy, maybe a mistake in calculation or a data entry fumble. But if that error is material, it still leads to a misstatement that the auditor has to address. And that brings us to our third major category of material misstatements: the appropriateness of financial statement presentation, or the appropriateness or adequacy of disclosures in the financial statements.
The disclosures.
Yeah.
The footnotes.
Exactly. Financial statements aren't just the raw numbers on the balance sheet or income statement. The accompanying notes and disclosures are absolutely crucial for context and understanding. They're the narrative that explains the numbers, gives them meaning. Without them, the numbers are just, data points floating in a vacuum.
Yeah, you need the story behind the numbers.
You do. So misstatements arise in this area when, first, the financial statements do not include all required disclosures.
Yeah, they just leave stuff out.
Yeah. Crucial footnotes explaining complex transactions or key policies might be missing entirely. This could involve details about significant debt covenants that restrict what a company can do, like maybe they can't borrow more money if their debt-to-equity ratio goes above a certain level.
Okay.
Or maybe contingent liabilities, like ongoing high-stakes lawsuits that could potentially cost the company a lot of money down the road. Or related party transactions, where a company does business with an entity owned by its own executives or major shareholders.
Right. Things you definitely want to know.
Absolutely. Without these disclosures, you simply don't have the full picture to assess risks or understand the true nature of the company's operations. Second, even if disclosures are present, they might not be presented in accordance with the applicable financial reporting framework.
So they're there, but maybe confusing.
Exactly. They might be confusing, poorly organized, or fail to meet the specific presentation standards required by GAAP. This makes them difficult for users to interpret even if the information is technically there. It's like having all the pieces of a puzzle, but no instruction manual or picture on the box. The info might be available, but it's practically unusable for decision-making. Third, and this is subtle but really important, the financial statements do not provide the disclosures needed to achieve fair presentation.
Going beyond just the technical rules again.
Yes. Even if a disclosure technically meets all the rules, it might still be insufficient to give a truly fair and transparent view of the company's financial position and performance given its unique circumstances. The spirit of disclosure is fair presentation, enabling a comprehensive understanding, not just ticking boxes for the bare minimum. And finally, a very specific and significant type of misstatement in this category, highlighted as a passkey in our sources, is when information that is required to be presented, such as a statement of cash flows, has not been included or disclosed in the financial statements.
Wow, leaving out a whole core statement.
Yeah. If a company issues financial statements that claim to present financial position and results of operations, but completely omits the related statement of cash flows, the auditor will normally conclude that this omission requires a qualified opinion.
That seems like a fundamental flaw.
It is. The statement of cash flows is one of the 3 core financial statements showing where cash came from and where it went. It's critical.
So it's not just about the numbers being right, but about the story the numbers tell being complete and transparent. Omitting something as fundamental as a statement of cash flows is a massive red flag. But why wouldn't the auditor just, create it for them? If they know it's missing, surely they could compile it.
That's a great question. And it really ties into this concept of practicable in auditing, which is crucial for defining the auditor's role.
Practicable.
Yeah.
Right.
Practicable basically means the information is reasonably obtainable from management's own accounts and records, and importantly, that providing it does not require the auditor to assume the role of a preparer of financial information.
They're the auditor, not the accountant for the company.
Precisely. The auditor's role is to audit the statements prepared by management, not to prepare them from scratch. Their expertise is in verification, attestation, not in financial statement compilation for the company itself. So an auditor won't create a missing basic financial statement, like an omitted statement of cash flows, or maybe detailed segment information if that's required. Their job is to identify that it's missing, confirm it's a required omission under GAAP, and then highlight that omission as a deficiency that warrants a modification to their opinion.
So they point out the problem and its implications.
Exactly. They point out the problem, explain why it matters, but they don't fix it for the company. It's a critical boundary in their professional responsibilities. It preserves their independence and prevents them from taking on management's role.
That makes perfect sense. They're the independent reviewers, the referees, not the players or the scorekeepers. That distinction is absolutely vital for maintaining trust in the whole audit process.
Couldn't agree more.
Okay, we've covered the what modified opinions are and the why, what kinds of misstatements trigger them. Now let's get into the how. How do these modified opinions actually look in an auditor's report? The specific structure and language can differ slightly, right? Depending on whether the company is a non-issuer, which are typically private companies, not on public stock exchanges.
Private companies, usually.
Or an issuer, which are the publicly traded ones. We'll start by decoding the reports for non-issuers, as our sources outline. How does it look for them?
Right. So for non-issuers, when a qualified or an adverse opinion is issued because of a financial misstatement, the auditor's report will specifically include a modified basis for opinion section and then, correspondingly, a qualified opinion or adverse opinion section.
Okay, so dedicated sections for the issue.
Exactly. Crucially, while many of the report's standard sections, like, the title, who it's addressed to, the responsibilities of management, the auditor's own responsibilities, they stay pretty consistent with a standard unmodified report. But the core changes, you, as a reader, will want to zero in on are specifically in those opinion-related sections. That's where the auditor's judgment really comes to life.
Got it. So let's zoom in on the qualified opinion first for these non-issuers. What does that section actually contain, and how does it specifically signal the issue to someone reading the report? What should you, the listener, be looking for?
Okay, the qualified opinion section is distinct. It should immediately catch your eye. It explicitly states that, in the auditor's opinion, except to the effects of the matters described in the basis for qualified opinion section, the financial statements are fairly presented.
Except for, that's the key phrase there.
Absolutely crucial. Except for, it's the auditor literally carving out a specific area of concern, a precise spot where they found a material misstatement that wasn't pervasive. Then, the basis for qualified opinion section is where the auditor provides a clear, precise description of the specific matter that gave rise to the modification. This is where you, the reader, learn exactly what the problem is, maybe how it arose, and its potential impact. Let's consider a sample report from the sources, where the qualified opinion is due to inadequate disclosure.
Okay, something's missing.
Right. In the qualified opinion section itself, you'd read something like, in our opinion, except for the omission of the information described in the basis for qualified opinion section of our report, the accompanying financial statements present fairly. That immediately tells you, okay, something important, some crucial piece of the puzzle is missing.
And then the basis section explains what?
Exactly. Then, if you turn to the basis for qualified opinion section, it might say something like, ABC Company's financial statements do not disclose details regarding a significant pending litigation, including the potential range of loss, which is required by accounting principles generally accepted in the United States of America. And it might add, in our opinion, disclosure of this information is required, but it is not practicable for us to present it in this report. This is a direct, clear warning about missing vital context that impacts the fair presentation and your ability to assess risk. The auditor, in their own words, tells you a critical piece of the puzzle is absent and why it matters.
Okay, that makes sense.
Okay.
Now, this next example from our sources seems even more concrete because it helps quantify the impact of a misstatement.
Yeah.
This is where it gets really powerful for the average reader, right?
Indeed. It's incredibly valuable for you because it moves beyond just a qualitative warning, something's wrong, to a quantitative impact. Here's how much is wrong.
Yeah.
Consider a sample report where the qualified opinion is due to a material misstatement regarding inventory valuation.
Okay, inventory.
The report might state first that ABC Company has stated inventories at cost in the accompanying balance sheets. Okay, seems straightforward. But then, the basis for qualified opinion section clarifies, accounting principles generally accepted in the United States of America require inventories to be stated at the lower of cost or market.
Lower of cost or market.
Yes, it's a fundamental gap rule. If the market value of the inventory falls below what it costs to acquire, maybe it's obsolete, maybe demand dropped, the company must write down the inventory's value to reflect that loss. Failing to do that would overstate their assets and their profits.
Makes sense.
But here's the truly crucial part and why this is so valuable for you, the reader. The auditor doesn't just state the violation, they quantify the impact. The report continues, something like, if the company stated inventories at the lower of cost or market, a write-down of $1,500,000 and $1,200,000 would have been required as of December 31st, 20X1 and 20XX, respectively.
Yeah. Okay, specific numbers.
Exactly. And it goes even further sometimes to show the ripple effect across the core financial statements. Accordingly, cost of sales would have been increased by $1,500,000 and $1,200,000, and net income, income taxes, and stockholders' equity would have been reduced by $1,050,000, $840,000, and $1,050,000 as of and for the years ended December 31st, 20X1 and 20X1, respectively.
Okay, that's phenomenal.
It is. It's phenomenal for you, the reader, because the auditor provides the exact dollar impact of the misstatement on key financial figures like profitability, and equity. It's like having the auditor translate the error into direct financial consequences.
Yeah, it allows you to mentally adjust the reported numbers and see what the financials should have looked like. That signals not just an error, maybe, but potentially a management that's unwilling to recognize bad news or face reality.
That's a very astute observation. That quantification is a game changer for anyone trying to understand the financials. It shifts it from just a vague warning to a concrete adjustment they can make in their own analysis.
Yeah, you can almost mentally correct the reported numbers yourself, which is invaluable.
It absolutely empowers you to make a much more informed decision, rather than just guessing at the significance, or worse, ignoring the qualification altogether.
Okay, now let's turn to the most severe opinion an auditor can issue due to financial statement issues. The adverse opinion. This is the financial equivalent of a flashing red light, just shouting, danger. What's different about this report for non-issuers, and what does it really mean for a company?
Right, the language here is far stronger, and the implications are much, much graver. In the adverse opinion section, the auditor uses unequivocal language. They state that because of the significance of the matters described in the basis for adverse opinion section, the financial statements do not present fairly in accordance with the applicable reporting framework.
Do not present fairly. That's blunt.
Extremely blunt. It's the ultimate condemnation regarding the statements. It means the financial statements, looked at as a whole, are fundamentally misleading and cannot be relied upon to make economic decisions. This isn't just an error in one specific area, it's a statement that the entire financial picture presented is distorted and untrustworthy. As with a qualified opinion, the basis for adverse opinion section then details the specific, but in this case pervasive matter, giving rise to this severe judgment.
Okay.
And a key structural difference for an adverse opinion, compared to qualified or unmodified, is that the auditor should not include a key audit matter section in the report.
Why not?
The reason is pretty simple. The adverse opinion itself is the overwhelming, all-encompassing key matter. There's really no need to highlight other specific issues when the entire set of financial statements is deemed fundamentally unreliable. The main message is the adverse opinion itself.
Gotcha. The source provides a clear sample of an adverse opinion involving a company that didn't consolidate a subsidiary. That sounds like a huge red flag, something that would completely distort the picture of a company's true size and financial health.
It absolutely is, and it's a perfect illustration of a pervasive misstatement. In this scenario, the sample report describes ABC company acquiring XYZ company, but, as described maybe in Note X, not consolidating its financial statements.
So they owned it, but didn't combine the financials.
Right. Instead, ABC company accounted for it on a cost basis, essentially treating it like just a passive investment rather than an entity they actually control. The auditor explicitly states in the basis for adverse opinion section something like, under accounting principles generally accepted in the United States of America, the subsidiary should have been consolidated because it is controlled by the company.
Okay, clear violation.
A direct violation of a core JAP principle. If you control another entity, you generally must combine their financials with yours. And here's the truly chilling part, which really highlights the pervasive nature of the problem. Quote, had XYZ company been consolidated, many elements in the accompanying consolidated financial statements would have been materially affected, including revenue, expenses, assets, liabilities, and equity. The effects on the consolidated financial statements of the failure to consolidate have not been determined.
Wow. They couldn't even figure out the total impact.
Exactly. This isn't just an error that can be easily quantified like the inventory example. It's a fundamental omission so widespread that the auditor cannot even fully determine its effects across every line item. It signals that the financial statements are so incomplete and distorted that they are fundamentally unreliable. They cannot be used to understand the company's true financial standing.
So you're effectively looking at only a piece of the financial puzzle.
And the missing part is substantial and completely integrated with everything else. The consequences for a company receiving an adverse opinion are incredibly severe. Extreme difficulty obtaining loans, maybe inability to raise capital, total loss of investor and stakeholder trust, intense regulatory scrutiny.
It sounds like the financial equivalent of being declared bankrupt on the spot almost, even if the company still has cash.
That's a good analogy for the impact on trust and usability. It renders the financial statements fundamentally flawed.
So the company's financial statements are telling a fundamentally wrong story because a huge, material, and pervasive piece of the puzzle is missing or misrepresented. This isn't just a misstep, it's a foundational flaw, rendering the whole report essentially useless for decision-making. The implications are just profound.
That's precisely the devastating conclusion the auditor is communicating with an adverse opinion.
Okay, now let's pivot to issuers, the publicly traded companies. The stakes are often significantly higher here, aren't they? Given the broad investor base, the strict regulatory scrutiny from bodies like the SEC, and the immediate impact any news can have on stock prices.
Absolutely. The public markets are a different ballgame.
So because of this, there are some distinct differences in how modified opinions are presented in their audit reports compared to the non-issuers we just discussed.
That's a crucial distinction to make. For issuers, the auditor's report has a slightly different structure when it comes to modified opinions. Instead of having that separate basis for opinion section like we saw with non-issuers,
Right.
the auditor's report for an issuer will include an additional paragraph immediately following the opinion paragraph, and the opinion paragraph itself will also be modified to refer to it.
Ah, okay. So the explanation comes right after the opinion itself, more prominent.
Exactly. This additional paragraph is where all the detailed explanations of the modification are placed, making it very prominent, right up front after the verdict, so to speak. Also, it's important to reiterate that for an adverse opinion on an issuer's financial statements, the auditor is not required to report critical audit matters, or CAMs.
Right, same reasons as non-issuers. The adverse opinion trumps everything.
Precisely. The adverse opinion itself is the most critical audit matter possible. It overrides any need to list other specific CAMs.
Okay, so how does a qualified opinion look for an issuer then? What's that crucial additional paragraph all about? And how does it convey the specific issue to public investors who might be making buy or sell decisions based on this very report?
Right. So for an issuer's qualified opinion, the opinion section itself is directly modified. The second sentence of this section will include the appropriate qualifying language, like except for or with the exception of, and critically, it will contain a direct reference to that separate additional paragraph that immediately follows.
So it points you right to the explanation.
Instantly. It tells you right away, there's a qualification here, and you need to read the very next paragraph for all the specific details. Now, this additional paragraph, or paragraphs, is the key distinguishing feature for issuers. It's placed immediately following the opinion paragraph, and interestingly, it typically has no specific heading, it just launches into the explanation.
Okay.
This paragraph is designed to be highly informative and must include all the substantive reasons that led the auditor to conclude there was a departure from GAAP. This is where they spell out the nature of the misstatement and exactly why it's a problem under the accounting rules. And critically, for issuers, it also requires the disclosure of the principal effects of the subject matter of the qualification on financial position, results of operations, and cash flows, if practicable.
Ah, the quantification again, but maybe even more strongly emphasized for public companies.
Yes, the requirement is very clear. If the auditor can reasonably determine the precise dollar impact of the misstatement on key financial metrics, they are required to state it right there in the report. This is a massive transparency win for investors in public companies.
Definitely.
If for some reason those effects cannot be reasonably determined, the report must explicitly state that fact. Now, if the company itself has already provided these exact disclosures in a note to its financial statements, the auditor's explanatory paragraph can be shortened by simply referring you to that specific note.
Okay.
But unlike non-issuers, there isn't that separate basis for qualified opinion section further down. This additional paragraph serves that purpose, placed directly after the opinion itself for maximum visibility and immediate context.
Okay, let's unpack the specific example provided for an issuer's qualified opinion. Uncapitalized lease obligations. This seems like a perfect illustration of that additional paragraph in action, and it sounds like something that could definitely mislead investors if it wasn't highlighted right away. Why might a company choose not to capitalize leases in the first place?
Well, it's an excellent example of a common issue where companies might try to present a rosier financial picture, particularly regarding their debt levels. In this scenario from the sample, the report describes X company's failure to capitalize certain lease obligations. GAAP absolutely requires many leases, especially long-term ones for significant assets, to be treated as assets and corresponding liabilities right on the balance sheet, rather than just being treated as operating expenses off to the side.
Right.
Companies sometimes historically avoided capitalizing leases to keep debt off the balance sheet. This can make their financial ratios, like debt to equity, look better. It makes them appear less leveraged or maybe more financially sound than they truly are if you just look at the balance sheet totals.
Sneaky.
So the additional paragraph in the auditor's report directly explains this, something like, the company has excluded from property and debt in the accompanying balance sheets certain lease obligations that, in our opinion, should be capitalized in order to conform with accounting principles generally accepted in the United States of America. Straightforward explanation. But then, and this is the crucial quantification of impact that provides that invaluable transparency for public investors, the paragraph continues with the numbers. If these lease obligations were capitalized, property would be increased by, say, $5 million and $4,500,000, long-term debt by $5 million and $4,500,000, and retained earnings by $300,000 and $250,000 as of December 31st, 20X2 and 20X1, respectively.
Wow, specific adjustments across the board.
Exactly, and it might go on. Additionally, net income would be decreased by $80,000 and $50,000, and earnings per share would be decreased by $80,005 and $3, respectively, for the years then ended. This level of detail is profoundly important for public market participants. The auditor is directly informing you, the investor, of the precise dollar impact on major financial metrics: assets, liabilities, equity, net income, earnings per share.
Yeah.
This allows you to effectively correct the reported numbers in your mind, or maybe in your own financial models,
Right.
to understand the company's true financial standing despite the numbers they initially reported.
Right.
It highlights that the company's reported asset base is understated, its debt is understated, and its true profitability, and thus its earnings per share, is impacted by this specific accounting decision. It helps you adjust your analysis immediately.
That level of detail is incredibly powerful for public investors. It's like the auditor isn't just flagging an error, but providing the manual correction right there in the report, helping you understand the company's true financial standing despite the reported numbers. It really takes away the guesswork, which is so valuable in the public markets, where every piece of information is scrutinized so heavily.
It absolutely empowers investors with the precise information they need to adjust their analysis and truly assess the risk or the true performance of the company. Without that quantification, you'd be flying blind on what could be a potentially critical financial distortion. Now, while no specific sample report for an issuer's adverse opinion is provided in our sources, the general principle is the same. The adverse opinion means the financial statements do not present fairly.
Right.
The auditor would use equally strong language as with non-issuers to convey that the financial statements as a whole are materially and pervasively misstated. For an issuer, receiving such an opinion would likely lead to immediate and severe consequences. Oh, a massive drop in stock price, potential delisting from stock exchanges, inability to raise capital, a complete shattering of investor confidence, major regulatory investigations. It's about as bad as it gets for a public company's reputation and viability.
Yeah.
And just to hammer the point home, as we mentioned, a critical point for issuers is that an auditor is not required to include a critical audit matters, or CAM section, when issuing an adverse opinion on an issuer's financial statements. The adverse opinion itself is the paramount critical matter, full stop. Hashtag tag after ad.
Wow. Okay, what a deep dive that was into the incredibly important and sometimes complex world of auditors' modified opinions. We've journeyed all the way from the clean bill of health, that unmodified opinion, to the serious red flags of qualified and adverse opinions, and even touched on that hands-off disclaimer where the auditor just couldn't get the job done.
We really have. We've illuminated how crucial concepts like materiality is it big enough to matter, and pervasiveness, does it spread everywhere,
Right.
dictate the severity of an opinion. They distinguish between, a significant but maybe contained issue and a widespread fundamental flaw.
Yeah.
And we've broken down the exact types of misstatements, from using inappropriate accounting policies or applying the right ones incorrectly, all the way to crucial missing disclosures, or disclosures that are just poorly presented.
Man.
And we saw how these reports differ, sometimes subtly, sometimes significantly, between private companies, non-issuers, and public companies, issuers, with concrete examples like omitted cash flow statements, errors in inventory valuation, leaving out subsidiaries that should be consolidated, and even those uncapitalized lease obligations trying to hide debt.
This really isn't just dry accounting jargon, is it? It's the auditor's critical commentary on a company's financial story. Understanding these modified opinions empowers you, the listener, to read between the lines, spot potential issues that might otherwise be missed, and ultimately make far more informed decisions. Whether you're an investor, an analyst, or just someone trying to understand a business better, it's about gaining genuine insight that goes way beyond just the surface numbers. It tells you not just what the numbers are, but whether they can truly be trusted.
That's exactly right. Knowledge is truly most valuable when it's understood and then applied. These opinions aren't just regulatory checkboxes, they are the auditor's professional voice, honed by standards and experience, highlighting where a company's financial statements might be incomplete, inconsistent, or even fundamentally misleading.
Yeah.
They really encourage critical thinking and questioning assumptions, which is just essential in today's information-rich world, where a clean report isn't always the full story, and sometimes a modified one can tell you everything you really need to know if you just listen carefully.
So here's something to think about. Next time you look at a financial report, maybe glance beyond the headlines. What hidden stories might the footnotes, and especially the auditor's opinion section, be trying to tell you? If only you knew how to listen for those subtle or sometimes not so subtle clues. Keep those detective hats on.